A pleasant morning, noon, afternoon, and night to you, dear student. Welcome. For a certain time, me and my team will provide a clearer picture of franchise accounting. But before that, let us understand what is really meant by the word franchise. Next. McDonald's, KFC, Starbucks, and Subway. I wish we could have Subway. Are just some of the entities or businesses that greatly benefit from using the idea or the conception of franchise. Franchise is a method of distributing products or services throughout the world from one area to another area. It is used by the franchisor. The franchisor grants a right to the franchisee to sell its products and services. The franchisee pays consideration in exchange for the franchisor's trademark, its expertise, strategic management, and product or services. Both of the parties, the franchisor and the franchisee, signed a contract that states the stipulations, responsibilities, and right with each other. Next. From now on, these are the topics that we'll be discussing. Franchise fees, revenue recognition, initial franchise fees with corresponding cases and illustration, revenue recognition continuing franchise fee, revenue recognition area franchise fee, and continuing sale of supplies, tangible assets included in the franchise fee, an option to purchase. Okay, next reporter.
I will now discuss to you about franchise fees. So what is franchise first? Franchise is an agreement usually requires the franchisee to make payments, which is called the franchise fee. So what is franchise fee? Franchise fee is the payment a franchisee makes to the franchisor for the right to use the company's brand, products, and intellectual property. Or in short, franchisee pays these franchise fees to franchisor in consideration for the reputation, skill, products, and services contributed by the franchisor. This can be done upfront or on an ongoing basis to the terms of the franchisee's agreement. So we have two types of franchise fees. First is the initial franchise fee and then the continuing franchise fee. Initial franchise fee represents initial payment. So given na dun sa name niya, initial payment for establishing the franchise agreement and for providing certain initial services associated with the agreement. The initial franchise fee may be payable immediately in cash or for an extended period of time. So I will enumerate some initial services that a franchisor may render prior to the opening of the franchisee's operation. First is the assistance in site selection for the construction of the building. Second, supervision of the construction activity, which involves obtaining financing, designing building, and supervising contractor. Assistance in the acquisition of signs, fixtures, and equipments. Next, provision of bookkeeping and advisory services. Next, provision of employee and management training. Another one is provision of quality control. And then last initial service is provision of advertising and promotion. Second second type is the continuing franchise fee. So tulad nung nauna, initial, and then ngayon yung pangalaw is continuing. Continuing franchise fee represent continuous payment to the franchisor for providing specific future services such as advertising and for the continued use of intangible rights by the franchisee. These fees are usually based on the operations of the franchises. So ginagawa natin yung franchise kasi rather than making a business from scratch, a franchisee benefits from the brand acknowledgement and frameworks that the franchisor has as of now built. But these benefits comes with a cost, and that is the franchise fees. So we have two types of franchise fees, the initial and the continuing. Ang example ng initial is yung, for example, kukuha ka, i-franchise mo yung Jollibee. Bali yun kasi initial yung payment niya ay immediately in cash na yung franchise fee. Hindi katulad ng sa continuing franchise fee, ng example naman, ang madalas na example nito is yung mga royalties, mga royalties. For example, kasi diba continuing, kasi for example, yung royalty. For example, writer ako. Bale, lahat ng kinuha ako ng ABS-CBN, kunyari, example lang po, kinuha ako ng ABS-CBN book producer. So, lahat ng mabebenta nila na book ko, may royalty income ako na makukuha. So, that explains the difference. That explains what is franchise fee, and the two types of franchise fees. That's all. Thank you.
So, good day. My assigned topic is all about revenue recognition of initial franchise fees. Next slide. So, let's proceed to guidelines on how we are going to recognize initial franchise fees. So, under initial franchise fee, it can be paid into two ways. It can be paid on lump sum basis, or it can be paid on installment basis. So, if it's lump sum, there is one cash payment by the franchisee to the franchisor. So meaning, if there is substantial performance, then therefore we are recognize the revenue in its entirety. However, if there is no substantial performance yet, then regardless if it's lump sum payment, we still defer the recognition of the revenue by the substantial performance. Now, other method of paying initial franchise fee is installment, meaning installment accounting. So installment, there is down payment and a remaining balance will be paid on equal installment basis or through the issuance of notes payable or promissory note. Now, in recognition for down payment, as your initial franchise fee, we need to assess whether there is already some substantial performance or if there's none yet. So, if there is substantial performance, then therefore we need also to consider it whether if it's refundable or if the period of refund is already expired. Then, if it's non-refundable, we should to recognize it directly as our revenue and account it under accrual basis. So in accrual, we recognize income the moment we have earned it. However, if there is no substantial performance yet, so therefore the revenue will be deferred first and it will be accounted under installment method. So next slide. The problem recognizing revenue with regard to initial franchise fees generally results from two issues. So first one is the point at which the fee is to be considered earned. Second, the assurance of collectability of any unpaid portion of the fee. If the total initial franchise fee is not paid in full. So next slide. When we can say that there is already substantial performance. So first, when the franchisor is not obligated in any way to refund cash already received or forgive unpaid debt. Uh, Second, when initial service required of the franchisor by the contract or otherwise had been substantially performed. Next, no other material condition or obligation exists. So it is very evident there is a substantial performance when the franchisee already start to operate. So next slide. It is also have a direct franchise of initial services rendered by the franchisor shall be deferred until related revenue is recognized. But indirect costs shall be expensed when incurred. As mentioned in the text, direct costs will be deferred first. It will only be recognized as franchise cost when there is already recognition of revenue. So it is assumed that there is substantial performance when the franchisee actual commence operation of the franchise. So next slide. So we have here an illustration on January 5, 2016. McDo Incorporated granted a franchise to Mr. A. De Jesus to sell McDo products. The initial franchise fee or IFF is 10 million. So in February to November, McDo Incorporated rendered the following initial services under the franchise contract. So direct cost of initial services worth of 2 million, indirect cost of services 50,000. So in December 1, the franchisee Mr. A. De Jesus started business operation. So obviously in this illustration, McDo here is the franchisor and Mr. A. De Jesus is the franchisee. So let's try to account this illustration. So next slide. The initial franchise fee is paid in full when the agreement is signed on January 2, 2016. The following entries will be made by the franchisor during the year 2016. So in this case 1, assume that there is full payment. So our entry in January 2, 2016 is we debit cash for 10 million. Then we credit deferred revenue from IFF 10 million. So as you can observe, our 10 million will be deferred first because we are not already operate, so meaning there's no substantial performance already. So next, to account for costs incurred during February to November, we have 2 million direct franchise costs and indirect cost of 50,000. So we need to defer first our 2 million. Then our entry is um, debit deferred cost of franchise revenue 2 million, uh, franchise expense 50,000, then credit cash 2,050,000. Next, we need to take note that in December 1, Mr. De Jesus started to operate hi- his business, so that means we could say that there is already substantial performance on December 1. So, since there is already a substantial performance, we can recognize initial franchise fees. So, in this case, we will now recognizing our cost of revenue by debiting it. So, our entry is cost of franchise revenue worth of 2 million, then credit deferred cost of franchise revenue 2 million. Then since there is already substantial performance and there is a full payment of initial franchise fee, so the entire 10 million we also recognize as revenue. So our entry is deferred revenue from IFF 10 million, then revenue from IFF worth of 10 million.
Now let's discuss case 2. The illustration here is already presented a while ago, but I also put it here in the slides for us to review, for us to not get so confused about the problem. So on January 5, the McDonald Incorporated granted the franchise to Mr. A. De Jesus with an initial franchise fee of 10 million. And in February to November, the McDonald Incorporated rendered initial service under the franchise contract with a direct cost of initial service of 2 million and the indirect cost of service of 50,000. And in December 1, Mr. A. De Jesus, the franchisee, started operating its business. So here in case 2, Mr. A. De Jesus, the franchisee, just only paid 1 million out of that 10 million initial franchise fee, and the remaining balance will be paid through 5 annual installments, evidenced by a 12% promissory note. Since in this case the idea of extended period is recognized, there are 2 methods to use to account appropriately and the collection of the payment of initial franchise fee. First, the accrual method, and second, the installment or cost method. The difference between these 2 methods lies on its collectability and revenue recognition. In accrual method is used when there is a reasonable assurance as to the collection of the remaining initial franchise fee, and revenue is recognized fully at the end of the year, for such reason that there is a reasonable assurance. And the installment or cost method, it is used when there is no reasonable assurance as to the collection of the remaining initial franchise fee. Revenue is recognized in proportion to the collected initial franchise fee. Since there is no specific instruction or word that tells us what method to use in this illustration, we will try both of the 2 methods. First, the accrual method. Please do remember that all of this instruction or all of these entries is in the point of view of the franchisor. Okay? On January 2, 2016, the franchisor debited cash because the franchisor received a 1 million cash from the franchisee or Mr. A. De Jesus. And the franchisor also debited notes receivable because there is still a remaining balance to the initial franchise fee of Mr. A. De Jesus worth 9 million. And Mr. A. De Jesus promises to pay this through a 5 annual installment with a 12% interest. And the franchisor credited deferred revenue from initial franchise fee because this revenue is still not recognized. That is the reason why it is deferred, worth 10 million. This is to record the initial franchise fee of Mr. A. De Jesus. February to November, the McDonald Incorporated rendered initial service under the franchise contract with a direct cost of 2 million and indirect cost of 50,000. So the franchisor debited deferred cost of franchise revenue because such cost is not yet recognized by the franchisor, worth 2 million, and the franchise expense from the indirect cost worth 50,000, and of course the franchisor credited cash worth 2,050,000. This is to record the cost of the service or rendered. On December 31, the company or the franchisor receives a cash, debit to cash, 2,880,000 from that first installment of 1,800,000 and an interest income of 1,080,000. That is get by multiplying the remaining balance of 9 million to the 12% interest of the promissory note. Since there's still no recognition of revenue and costs, we don't need to adjust the entries. At the end of the year, the franchisor adjusted the entries by debiting the cost of the franchise revenue worth 2 million to recognize appropriately the cost at the end of the year fully, and deferred cost of franchise revenue to offset such deferred. And the franchise also debited deferred revenue from the initial franchise fee to recognize revenue, and a revenue from credited revenue from initial franchise fee worth 10 million. This is to recognize revenue fully. Okay, next slide. The statement of comprehensive income of the franchisor for the year ended December 31, 2016. So there's a revenue from the franchise or initial franchise fee worth 10 million, and the cost of the franchise revenue 2 million. Then there will be a gross profit of 8 million. 10 million minus 2 million, there will be 8 million gross profit, and less the expenses of 50,000. So there will be an operating income of 7,050,000, plus the interest income of 1,080,000. So there's a net income of 8,130,000 from the 2016 operation or transaction between the franchisee and the franchisor. Okay, next, now let's go to the installment or cost method. Both of the method have the same journal entry from January to December. The difference lies on the adjusting entry because they have different way of recognizing revenue at the end of the period. The first adjusting entry in the installment method is to recognize the cost from the franchise revenue. So debit cost of the franchise revenue 2 million, credit deferred cost of the franchise revenue 2 million. That is to recognize the cost from the franchise revenue. The second adjusting entry is to set up the gross profit, because that gross profit will be the base for you to know the realized portion and the unrealized portion. Okay, so debit deferred revenue from the initial franchise fee 10 million, credit cost of the franchise revenue 2 million, deferred gross profit from initial franchise fee 8 million. The third adjusting entry is to recognize the realized portion of that gross profit. For us to get the realized portion, we need to add the collected part of the initial franchise fee, that is the down payment and the first installment, and multiply it to the rate, gross profit rate, that could be get by dividing the established gross profit to the revenue 10 million. So 8 million divided by 10 million, that will be 80%. So we need to get the 80% of that collections, 2,800,000 times 80%. So that will give us a realized gross profit of 2,240,000. So therefore, there will be a debit to deferred gross profit from initial franchise fee of 2,240,000 and a credit to realized portion of gross profit from initial franchise fee worth 2,240,000. So now let's proceed to the statement of comprehensive income. So this is just a reflection of the previous transaction or the transactions that we discussed just a minute ago. Okay, revenue from the franchise fee worth 10 million less the cost of the franchise revenue, so that will give us a gross profit. The deferred gross profit of 8 million. So we deduct the deferred gross profit and 5,760,000 that can be get by deducting or subtracting 8 million to 2 million to the realized portion, that is 2,240,000. 8 million minus 240, that we could get 5,760,000. You get it? Less deferred gross profit end, or the unrealized portion of gross profit, that is 5,760,000. That will give us a realized gross profit of 2,240,000. Less expenses of 50,000 will give us an operating income of 2,190,000. And then plus the interest income of 1,080,000. That will give us a net income of 3,070,000. That's the end of the case 2. Now let's proceed to the case 3. Next reporter, please.
Hello everyone, so let us now continue our discussion about franchise fees, and we are now on our case 3. So for us to answer the amount for our entries in this case, there is a figure that will help us. So in case 3, there is the statement of comprehensive income of the franchisor for the year ended December 31, 2016 is presented below. So here presents a statement of comprehensive income where the net income is solved. So let us now proceed to our question. So in case 3, the initial franchise fee is payable as follows. So cash of 1 million upon signing of the contract, and the balance in 5 equal installments every December 31, evidenced by a non-interest bearing note. So credit investigation indicates the franchisee can borrow money at 12% and the present value of an ordinary annuity of 1 at 12% for 5 periods is 3.6048. Thus, the present value of the five payments of 1,800,000 would be 6,488,640. Assuming that the collectibility of the note is not reasonably assured, using the installment method of revenue recognition, the required entries in the books of the franchisor during 2016 are. So before we answer the entries, let us first know how we got the present value of 3.6048 and the 6,488,640. So I will present here. So in knowing the present value, so let us first answer the present value of an ordinary annuity of 1. So the formula would be, so we will solve it by, so you add 1, so 1 is already as is. So you add 1 by the percentage given. So the percentage given is 12%. So you add 1 to the 12%. So that would be 1 plus 12% or 0.12, which will give you a 1.12. And then after you have already 1.12, you press the divide button. We are using the basic calculator. So you press the divide button twice, so 1, 2, and then you will press the equals button and the M plus. So it depends how many periods. So in our case, we have 5 periods. So you will press equals M plus, that is 1, then equals M plus, that is 2, equals M plus, then 3, then up to 5 periods. So let us try. So we have 1.12 divide Again, 1.12, then 2 divide 1 2, and then equals m plus for 5 periods. So 1 2 3 4 5. And then after pressing the equals and m plus for 5 times, you will press the MR button, which will give you a 3.6047762228, and rounded off, that would be 3.6048. So that is how we got our present value. So to get the present value of our note, we remember the 1,800,000. So the 1,800,000, you times the 1,800,000 to the present value that we had gotten a while ago. So that would be 3.6048, which will give you 6,488,640. Since we already finished solving our present value of the note and the present value, we need to go back to the problem, which is the case 3, and underline the important information. So underline the initial franchise fee is payable as follows. So you underline the cash of 1 million, and then the non-interest bearing note, which is evidenced by non-interest bearing note, and then we should also underline the percentage, of course, and the 5 periods, which is 3.6048, and the 1,800,000. Let us underline that, and then when you multiply the 1,800,000 to 3.6048, let us underline also the 6,488,640, and of course we need to know the collectibility, because that is very important in the franchise fees. And then it is said here that the collectibility is not reasonably assured. So let us underline that. And then the word installment method is already highlighted, which is installment method, which is also the same with the gross profit method. So now let us proceed to the entries. So what will be the entries of the franchisor during 2016? So for our entries to January 2, 2016, our first entry would be, so we debit cash and notes receivable. So cash would be 1 million and the notes receivable would be 9 million. So how did we get the amount for 9 million? So to get the face value of the note, we get from the statement of comprehensive income, there is a revenue from franchise fee, which is in the amount of 10 million, and then we deduct the cash of 1 million upon signing of the contract. So that will give you the 9 million, which is seen in the notes receivable, and then so the amount of cash is the cash of 1 million upon signing of the contract. So next is, so we will credit the unearned interest income, and then credit as well the deferred revenue from IFF or the initial franchise fee. So let us first compute the amounts for the unearned interest income and the deferred revenue from IFF. So for the computations, let us first compute for the unearned interest income. So we have the face value of the note, which we did solve earlier. So that is 9 million, and the present value of the note, which is the 6,488,640, which we already did solve as well. So what you do is you deduct the two. So 9 million minus 6,488,640 will give you 2,511,360. So that is the amount in the unearned interest income. So we defer. So why do we defer? Why do we put a deferred revenue here? Because we are going to adjust the entry. So whenever there is a deferred revenue, we defer the accounts so that we can adjust these entries. So to get the adjusted sales value of franchise, we put first the down payment, which is the 1 million upon signing of the contract, and then the present value of the note, again the 6,488,640, and then you add these two to get the adjusted sales value of franchise. So that is 7,488,640. So that is the amount for the deferred revenue from IFF, or the initial franchise fee. That is to record the receipt of initial franchise fee. So that is just for January 2, 2016, and we are not done yet. Then after that, we are going to do entries from February to November. So our first entry to February to November is we debit the deferred cost of franchise revenue and the franchise expense. So where did we get these amounts? So here, so for the amount of deferred cost of franchise revenue, we have 2 million, which we got from the statement of comprehensive income, which is the cost of franchise revenue, that is 2 million, and the franchise expense is the expenses, that is the 50,000. So we have here deferred cost of franchise revenue 2 million and franchise expense of 50,000, and you add the two, so you credit cash, and then the amount would be 2,050,000. That is to record costs of services rendered. So for our last entry for December 31, to record the collection of the first installment, we debit cash, and then we credit notes receivable in the amount of 1,800,000, which we got from the payments dun sa ating present value, yung 1,800,000 itself lang. So yun yung ating entry for December 31. So 1,800,000. So since we are done with our entries, we are now here for our adjusting entries. So for our first adjusting entry, we debit unearned interest income and credit interest income. So when a portion of income is allocated to one period at a time, so for us to amortize the prepaid interest, we debit unearned interest income and we credit interest income. So this is to adjust the interest income for 2016. So our unearned interest income would be 778,637. So how did we get this amount? So the present value of the note, which we did solve a while ago, so that would be 6,488,640 multiplied by the percentage given as well in the case. So times 12%. So 6,488,640 times 12% will give you, so that is 778,636.8. So rounded off, we have 778,637. So that is the amount. So for our second adjusting entry, we debit the cost of franchise revenue and we credit the deferred cost of franchise revenue. So that is to adjust the cost of franchise revenue, and that is only 2 million, which is the cost of franchise revenue. So that is 2 million. Then for our third adjusting entry, since we since in January 2, 2016, we had the deferred revenue from IFF, and now we're going to adjust them. So we debit deferred revenue from IFF. So that is 7,488,640. So how did we get the 7,488,640? Nakuha na natin siya kanina pa, which is from the so that is the adjusted sales value of franchise. So now let us go back, and then we credit the cost of franchise revenue, which is already given. That is 2 million. So the deferred gross profit from IFF is that you deduct the 7,488,640 minus 2 million, which will give you the 5,488,640. So that is to defer gross profit from franchise fee. So for our last adjusting entry, we need to recognize the realized gross profit. So we debit the deferred gross profit from IFF, and we credit the realized gross profit from IFF. So to get the amount for this adjusting entry, there is a computation. So collections applying to principal. So first, we must add the down payment in the first installment. So the down payment is yung cash of 1 million upon signing of the contract, and then the first installment. So remember the 1,800,000. So you deduct the 1,800,000 to the 778,637, which we got from our first adjusting entry, the wherein the interest income. So we deduct that. So 1,800,000 minus 778,637 will give you 1,021,363. I mean, so we add the two, so we will have 2,021,363. My bad. Now we have our 2,021,363. We multiply it to the gross profit rate. So how to get the gross profit rate? So from our previous adjusting entry, we have there the deferred gross profit from IFF. Do you remember? So the 5,488,640, we divide it to the deferred revenue from IFF, which is the adjusted sales, the adjusted sales value of franchise. So we divide it to the 7,488,640, which will give you 0.7329 ... Then we multiply it to 100. So you have here 73.29%. So we multiply it to the 2,021,363 times 73.29%. So we have 1,486,456.9427. Rounded off, we have 1,481,457. So that is how we got our deferred gross profit from IFF and the amount to the realized gross profit from IFF. Now we are done to our installment method of revenue recognition. There is actually an alternative method. So the same pa rin ang info. So the notes receivable is, the collectibility of the notes receivable is as well not reasonably assured, but instead of using the installment method, you can also use the cash basis of revenue recognition. So we only use the cash basis of revenue recognition when the direct cost of the initial services is minimal. So remember our cost of franchise revenue, we have 2 million. So, papalitan natin yung data doon. So dito sa case 3 natin, so, the same pa rin, the same information, pero, ang papalitan lang natin is our cost of franchise revenue, our direct cost of initial services. So, gagawin natin siyang, instead of 2 million, gagawin natin siyang 200,000. So, if ganun man ang case, what will be the required journal entries? So, let us know. So, let us put the year 2016, and below 2016, let us put the date, January 5. So, for our first entry, pareho lang siya sa ginawa natin kanina. We debit the cash and notes receivable. Cash, 1 million. Notes receivable of 9 million, which is the face value of the note. And the 1 million is the cash of 1 million upon signing of the contract. So, we credit unearned interest income, which na-solve na rin natin kanina, the 2,511,360, and the deferred revenue from IFF is the adjusted sales value of franchise. So we have 7,488,640 to record the initial franchise fee. So for our next entry, dito na sila nagkaiba. So, February to November. So, sa installment method na ginawa natin, ang ating entry sa debit side niya is deferred cost of franchise revenue. So, dito, since sabi dito sa method na ito, revenue is recognized as cash is received. So, ilalagay natin debit is prepaid franchise expense na 200,000, which is nabigay na 200,000 yung pinalitan nating data, and then we debit the franchise expense 50,000 pa rin yung expenses natin, and we total it for a credit of cash na 250,000 to record cost of services rendered. So for our last entry, the same lang din siya sa ginawa natin sa installment method. So we debit the cash and we credit the notes receivable, so that is 1,800,000. So, to record collection of the first installment. So this alternative method has also adjusting entries. So, for our first adjusting entry, the same lang din siya sa unang ginawa natin to adjust the interest income. We debit the unearned interest income and credit the interest income for the amount of 778,637. So, nakuha siya. We multiply the 6,488,640, which is the present value of the note, times the percentage, which is the 12%. So, for our next adjusting entry, so we need to recognize revenue from the initial franchise fee equal to the total collections excluding interest. So remember our solving kanina a while ago. So para makuha yung amount niya, so first i-debit muna natin si deferred revenue from IFF and we credit the revenue from IFF. So, nakuha yung amount nila by i-add mo si down payment and the first installment. So, si 1 million, i-add mo kay 1,021,363. So, that is our amount in the second adjusting entry, the 363. We have 363. So, kasi excluding interest, so kaya si 2 million lang. 2,021,363. So, for our last entry, for our last adjusting entry, we debit franchise expense and we credit the prepaid franchise expense, that is to adjust the prepaid expense. So, that is in the amount of 200,000 lang. So, that is the end of our adjusting entries. So, A reminder to everyone. So, in the above journal entries, the direct costs of services rendered by the franchisor was deferred by debiting. It was already deferred. So, by debiting the prepaid franchise expense account. So, this shall be charged to franchise expense account only upon recognition of revenue from franchise fee at the end of the period. So, the book that I am using, so the authors of this book agreed to use this kind of method because of its simplicity. So that would be the end of my report in this case 3.
Good day, class. My topic for today is about revenue recognition, continuing franchise fees. Now, for the introductory, we are going to have it is collected from the franchisee at the end of each month based on a certain percentage of their monthly sales. We're going to base it on their monthly sales. Okay, the continuing franchise are reported as earn and become receivable from the franchisee. An exception to the foregoing exists if the franchise constitutes an agency relationship under which a designated portion of the continuing fee is required to be segregated and be used for a specified purpose. In that case, the designated amount should be reported as liability against which the specified cost will be charged. Now, sometimes a large initial franchise fees are required, but a continuing franchise fees are small in relation to featured services. Okay. In order for us to recognize the revenue, we are going to have the journal entry to debit for cash and credit for revenue from continuing franchise fee. And also, we are going to take note that all of the direct and indirect expenses that are related to the continuing franchise fees shall be expensed when they are incurred. Okay, we must remember that all direct and indirect costs that are related to continuing franchise fee shall be expensed as incurred. Okay, in order for us to recognize the cost related to expense, we're going to have a journal entry for debit for franchise expense and credit for cash. Okay, the journal entry will be debit for franchise expense and credit for cash. Okay. So okay, next one will be about a portion of initial franchise fee shall be deferred and amortized over the life of the franchise. Okay, tandaan natin, the initial franchise fee shall be deferred and amortized over the life of the franchise. If it is probable that the continuing franchise fees appear to be insufficient to cover the cost of accounting services and a reasonable profit of the franchisor for the continuing services required by the franchise agreement. Okay? The portion of the deferred and amortized should be an amount sufficient to cover the estimated cost of continuing service plus a reasonable profit. Okay? So dapat yung portion ng initial franchise fee natin na gi-deferred natin at gi-amortize is dapat sufficient enough, okay, to cover the estimated cost of the continuing service plus a reasonable profit. Okay? Okay, let's say for instance, it is not sufficient enough to cover the estimated cost and excess of continuing franchise fee. So, if that is the case, if it is probable that the continuing franchise will not cover the cost of the continuing services to be provided by the franchisor and a reasonable profit on those continuing services, then a portion of the initial franchise fee shall be deferred and amortized over the life of the franchise. Okay, and then the next topic is about revenue recognition area franchise fee. Okay. So, itong revenue recognition area franchise fee is the same principles with individual franchise sales. Okay, that is, revenue ordinarily should be recognized when a material, or I mean all material services or conditions relating to the sales have been substantially performed or satisfied by the franchisor. The only difference is that a substantial performance of services rendered by a franchisor is difficult to determine. Okay. Next. In order for us to determine the revenue to be recognized from an area franchise fee, we are going to have the percentage of completion method. Okay, so the method that we are going to use is about percentage of completion method. Okay, the formula for percentage of completion method is we're going to have a cost of servicing each individual franchise within the area divided by or over total cost of all franchise that are expected to be open in the area. So the resulting figure of this percentage will be used in order for us to determine, the area revenue. Now, we're going to have the percentage of revenue times the initial franchise fee. So that will be all in my report. Thank you for listening.
So, good day everyone. Today I will discuss to you the last two remaining topics from Chapter 10, Franchise Accounting, which is the continuing sale of supplies, tangible assets included in the franchise fee, and lastly, the option to purchase. So, let's start. Continuing sale of supplies. As part of the continuing service offered in the franchise contract, like advertising, franchisor normally provides equipment to the franchisee. The franchisor keeps track of the selling in the normal way. These sales are required to ensure uniformity in the standard of the supplies used by all of the franchisees. Franchisee purchases a portion from the franchisor. If the franchisor has no equity interest in the franchisee, this transaction presents no particular accounting problem. The transaction should be reported following conventional guidelines by recognizing revenue and expense when sale and delivery takes place. Is tangible assets included in franchise fee? Franchise fee covers initial training, supplies, and gives access to unique goods or services associated with the franchise. The franchise fee is recorded at its full present value amount on the balance sheet. The franchise fee is listed under the asset section as an intangible asset. Commonly, ang franchise fee kay part ng intangible asset, but there are some instances where besides the initial services of the franchisor, the initial franchise fee may include the sale of specific tangible property such as inventory, signs, equipment, or real property. Thus, a portion of the initial franchise fee must be allocated to such tangible property at its fair market value. The fair value of the tangible property is recognized as revenue when title to such property passes to the franchisee, even though substantial performances has not occurred for other services included in the franchise agreement. A portion of the fee deemed applicable to tangible assets may be recognized prior to or later than recognition of another portion deemed applicable to services. For example, depending upon the terms of the agreement, the portion of the fee related to the sale of specific tangible assets may under appropriate circumstances be recognized when title passes, whereas the balance of the fee related to services may be recognized when the balance of the contract has been substantially performed. Finally, the last topic is option to purchase. The franchise agreement may include a provision to the effect that the franchisor has an option to purchase the franchise business. An option to purchase agreement is an arrangement in which agreement between the buyer and seller of a property, and is the most common way of parties to enter into a contract for sale and purchase of property. Typically, the seller grants the buyer an option to purchase the property based on terms and conditions in the option to purchase in return of a sum money from the buyer. The option to purchase is used for the prospective buyer to reserve the property. This is because of an agreed period of time stated in the option to purchase agreement, known as the option period. Only that particular buyer will be able to purchase the property and not to anyone else. The option period is usually 14 days, but may be negotiated between parties. Thus, the option to purchase is useful as the seller is not allowed to sell the property to any other buyers during the given option period, while the buyer has the same period of time to consider whether to go ahead with the purchase. When all the terms are eventually agreed upon, the seller will sign the option to purchase and the buyer will pay the option fee. If the option is granted at the time the franchise agreement is agreed upon, the seller will sign the option to purchase and the buyer will pay the option fee. If the option is granted at the time the franchise agreement is signed, the initial franchise fee is to be deferred. When the option is exercised and the franchisor acquires the franchise business, the deferred revenue from the initial franchise is treated as a reduction from the franchisor's income.
And that is the end of our discussion about franchise accounting. I hope that you've enjoyed learning. I hope that you've learned so many things that you can use in the future. And bye. Have a great life. Thank you.